What's up everybody, I'm Jaspreet Singh, and having good money habits today is very difficult because for one, we are in a very tough economy with the economy slowing down and inflation running hot, and then on top of that, we have this culture where it is very normal and glorified to almost be bad with money. People like complaining about money problems on social media. They love flexing all the nice stuff that they can't afford on social media. And so what I want to do today is talk about some of the most important money habits that you have to have before you turn 40, because now until that time you want to be making sure you're working on these money habits to get it all in place. That way you can really set yourself up for financial success and wealth. And it all starts with number one, stop bleeding cash, and in this case knowing how to pay down your debts. Because when you have consumer debts that are consuming you, which are your student loans, your credit card debts, your home equity lines of credit, your hard money loans, your payday loans, your buy now, pay laters. These types of debts are where you're spending your income today to pay off all the liabilities, all the luxuries, all the consumer expenses that you couldn't afford yesterday. When you get stuck in this type of rat race, all you're doing is you're going to work today to pay off your banker for the things that you bought yesterday. I was watching a podcast yesterday, and what they were saying was the number one way for you to become wealthy and set yourself up for financial success is to pay off your student loans before you turn 30. And that's a great thing to do, but what happens now if you have $500,000 worth of student loans because you went to medical school and you didn't graduate until you're 28 or 29? Or what happens now if you're 22 years old and you have $40,000 worth of student loans and you don't really start paying it off until you're 28 or 29 or 30? And so yes, if you can pay down your student loans ASAP, that's great, but by the time you're 40, you have to know how to pay it off, if not pay it off completely, because this is where it's not just your student loans, it's your student loans, the credit card debt, all those debts that are for your consumer liabilities, the things that are not putting money in your pocket. If your debt isn't paying for itself, because even student loans fall under this category, if your debt isn't paying it off through its own asset, you need to pay it off as soon as possible. Now, as much as people try to strategize the best way to pay down debt, at the end of the day, the debt strategy method ultimately comes down to this. This is your debt that you have, and if you want to pay it off, you need to have cash to throw at your debt to pay it off. And there are two ways to get this extra cash. Either you can spend less money or you can earn more money. In either of these cases, this is going to give you a bigger margin because now you have your income and your expenses. Either you can increase your income or you can cut your expenses, or you can do both at the same time. This is going to give you a margin, which means you're going to have cash that you can use to attack this debt and pay it off. And the faster you pay it off, the less debt that you're going to have to pay because, well, the less interest that you pay. Because now the more you pay today, the smaller your principal balance will get and the smaller the interest that you're going to have to pay now because your balance is getting smaller. So it literally pays off to attack your debt sooner rather than later. This is where people try to get into the nitty-gritty. Should you follow the Dave Ramsey model, which is the snowball model, where you're paying off the smallest debt balances first and then you're gradually getting bigger and bigger and bigger? Or do you follow the debt avalanche method, which is now you're paying off the highest interest rates first? It really doesn't matter. The key here is the more money you put in towards your debt, I don't really care which method you follow, the more money you put in towards your debt, the faster you're going to be able to pay this off. And once you stop having this debt, once you stop bleeding cash, now you can take this extra money, this margin that you have now, and put it to work to make you wealthy. Because when you get stuck in this system of constantly just having all of your money going out to pay your banker's the one that's getting rich, but you are now working to keep your banker rich. So you want to pay this off as fast as possible. That way you can use your money to make yourself rich. The second money habit that you have to master if you want to become wealthy is you have to know, how do you spend the money that you have? Because we live in a society where you don't have to be able to afford something to be able to buy it, because you can buy pretty much whatever you want thanks to the help of credit cards and lines of credit and buy now, pay later. But that's going to put you right back into the problem that we just solved, is how do you pay down the debt? Because now when you're just buying things that you can't afford, well, now you are going to spend tomorrow's income paying off your yesterday's expenses. So what you want to do now is you want to understand the difference between being able to buy something and being able to afford something, and then spend your money based off of that. Dave Ramsey said it the best. He says that that you need to act your wage. And the way that you can do that, the simplest thing that you can understand is my rule of 5 when it comes to your liabilities, which are not necessary to you living your life. And that means in the rule of 5, if you cannot buy 5 of them, you cannot afford 1 of them. It's a very simple rule of thumb that will help you understand what you can afford and what you can't afford. And this also means that you have to understand how do you spend money on things like your car, because pretty much everybody thinks it's normal to have a car payment, because now when you want to buy a car, who is going to pay for a car in cash? Because now you can either lease it or you can have a car payment. Now leasing can work for some people or business owners in some situations for the tax purposes, the tax advantages. But I want you to think of leasing like flying first class. It is not the cost-effective way to fly. It is a luxury and you're paying extra for that luxury. That's what you get when you lease a car. So leasing is buying that extra luxury. It's flying first class. You're buying the extra luxury of being able to now switch cars and do everything that you get with a lease. Now, when it comes to actually buying the car, if you want to buy a car and you can't afford to fly first class, you shouldn't be leasing. Now you're comparing, okay, do I buy it with a car payment or do I buy a car outright? Right now, at the time of me recording this video, the average car payment for a new car is $644 a month, and the average payment on a used car is $488 a month. Now, not only do you have this car payment, but then you have to pay for your insurance, you have to pay for your car registration, you're gonna have to pay for your maintenance, and even you got the nice car, you also gotta pay for your premium gas. And then what happens to so many people is you get into this car payment game, where now you buy this car, you own it for 4 to 6 years, and then you pay it off, and then as soon as you pay it off, you feel a little weird because now you have a car with no car payment. So what happens? That's when people go out, they sell this car, and then they go and buy a new car, and then they start this car payment game all over again. So you just finally paid off the car, but then you started all over again. So then people keep these car payments going forever because it's so normal to have these types of car payments. But let's do the opposite now. What if instead of having a car payment, your car payment was going to invest in you? That way you can become wealthy. So let's just assume now that you took $550 a month and you, instead of buying a car, you use this money to buy you investments, whether it's on the stock market, maybe you're building up a real estate fund, because now with real estate crowdfunding, you can invest $500 a month, but you're investing $550 a month and you get just a 7% average return on your money. And you do this from the time you turn 21, which is when many people start this car payment game. And you do this until you retire. And you don't increase the amount of money that you're investing every month, even though your car payments are probably going to go up every 5 or 6 years because you're going to keep buying more and more expensive cars. But I'm going to assume now that you're only going to pay $550 a month into your investment portfolio every month from 21 until retirement. Well, if you do that for 45 years, guess what? You're going to have a retirement portfolio of over $2 million. Versus if you just pay this $500-600 a month for your car every single month, after you get to retirement age, guess what? You're going to have a car worth next to nothing. Cars lose value each and every day. Sure, maybe your car, if you have a nice car, will be worth $20,000, $30,000, $40,000, maybe 50 grand. But that's not $2 million, because here you're buying assets. Here you're investing this money into yourself to buy an asset. Here you're taking this cash and you're paying interest on it to buy a depreciating liability, something that's dropping value each and every day, and then you're paying interest to the bank on top of that. Now you might be saying, but Jaspreet, I need a car to get to and from work. Yeah, you're right. But do you really need a $40,000 or $50,000 or $60,000 car? I like nice cars. I want you to have a nice car, but the thing that I want you to understand is that your car is a liability. It's not making you any money. I still today drive a car that's worth about $500. Actually, 2 days ago, I got a call from my homeowner association because my car, it doesn't have a bumper on it anymore. And they called me and they said, hey, we got a couple of complaints from your neighbors saying that there's a black car in your driveway that's an unusable car that's just sitting there because they thought that it was a junk car sitting in my driveway, and they said that I should put my car into a storage unit. And I said, excuse me, well, this car takes me to my office every single day. I've been in California for a little while, so I guess that's probably why they were getting these complaints. But I drive my car to work every day and it takes me everywhere. And yeah, while I don't have a bumper, everything else is working. Now look, I make a good income, and yeah, I probably will buy a very nice car someday. But for me, I understand that my car is a depreciating liability, and right now I'm investing very aggressively. I don't want to spend 100 grand or 200 grand on the car today because I know that I'm going to take this cash and I can reinvest it. I can put it back into my business, market briefs. I can take this money and go out and buy stocks and go out and buy real estate. I can find the other opportunities because I am so focused. I am laser focused on building this thing that I never had, this wealth that I never had before, because I know how important it is for me, and I'm willing to sacrifice that nice car today. I will buy a nice car. Okay, I'm not saying you gotta drive a junk car for your whole life. I'm gonna buy a nice car. But I understand how it plays a part in my life because I understand the difference between an asset and a liability. And I'm more focused on building this than I am focused this. This is my number one priority. Well, my car is just taking me from A to B, and when I'm ready, I will buy another car. The third thing that you have to understand is how do you invest your money? And when I say how do you invest your money, I don't mean putting your money into your 401k or your IRA. If you're doing that, fine, but that should be the very base. That should not be the tip and end of your investments. You need to be investing your money yourself. Now, if by this time you realize, okay, I suck at investing my money, I hate investing my money, then maybe you can consider getting some sort of financial advisor or money manager to help you with that. But if you don't, now you got to figure out how you're going to be investing your money yourself. And what you're going to realize is maybe you're going to like stock market investing. Maybe you're going to like real estate investing. Maybe you're going to like cryptocurrency. Maybe you're going to hate stocks but love real estate. Maybe you're going to do something like that, but you have to understand how do you invest your money. And this starts with the basic education of understanding how you get paid. Because the way you get paid is going to dictate how you invest your money. Because you can get paid from cash flow, which I'll label CF, or you can get paid through appreciation. And this is when your investment value goes up. The reason why I love investing in real estate is because I can get predictable cash flow from my real estate. So the way it works is once you buy a property, whether it's a home, an apartment complex, whatever it is, you buy this property, you own it, and now you're going to rent it out to somebody else, and somebody else is going to be living here. I'm going to draw this person right here, draw him a nice mustache, or as we like to call it in my native language, Punjabi, a much. This person is going to be living in this property, and then they're going to be paying you rent every single month for living in your home. And the nice thing is, once you understand the ropes, once you understand how it works, it's going to be very passive on your end. Like, I don't know who my tenants are. I don't get involved with the day-to-day maintenance. I'm not involved with paying the bills. I have a property management company who the tenants deal with, and they do all of that work A to Z. But what they also do is make sure that I get paid. They deposit this money into my bank account. Now, of course, the property management company takes a fee, right? They're going to charge you money, so your rents are going to go down a little bit, but it gives me back my peace of mind. It gives me back my time, because now that I own the asset, this asset can generate me cash flow forever, as long as I own the asset and as long as the asset exists. And now I'm getting this cash flow, because now if you can think about it in terms of stacking assets, well, for me, I know that every house that I buy, it might put between $500 and $700 into my pocket of profit every single month. And so now it's just a game. How do I stack more? If I have 10, that's 5 to 7 grand of cash flow every single month, essentially passive, that I don't have to go and work for. If I can get 100, I know it's going to seem really far away. How in the world can you get 100? Because that's very hard, but that would be $50,000 to $70,000 worth of cash flow every single month. Now the question is, how do you put it in action? How can you buy 1 a year? And then as you start to grow, maybe 2 a year. And it's all about putting the plan in action, because the hardest one is the first one. But this is one way that you can get paid, is through cash flow. The second way is through appreciation. Appreciation is when the value of your asset goes up. Now you can do the same thing in real estate, where people will go out and buy a home for, say, $200,000 and then hope that this home will be one day worth $300,000 and then sell it for a profit. But I don't like to do that with real estate, because with real estate, I'm buying this cash flow. The people that get burned the most in real estate are the people that do this. They start looking for these speculative properties. They're hoping that they're going to be able to sell it for a quick profit. I don't like doing that. I'm not a trader. I'm not a flipper. I like to be a long-term investor, which is why when I invest in real estate, I don't care what's happening with housing prices. The only thing I'm looking at is how much cash flow that I'm getting. However, you can build this appreciation as a long-term investor. Because remember, there's a difference between trading and investing. Trading is now when you're trying to flip something. You buy something for 100 grand or 1 grand or $100 today, and then you hope that you can sell it for 50% more in the next 6 months. I don't play that game. So when it comes to appreciation, I'm looking for now investments that I believe in for the long-term value. This can be stocks on the stock market. It could be my real estate where I'm not buying it for the appreciation, but if I get appreciation, that's icing on the top. Or it can also be cryptocurrency if you believe in crypto. If you don't believe in crypto, don't buy crypto. But now, the whole idea here is you want to look for these investments that you can hold on to for the long term. And by long term, I don't mean 6 months. I don't even mean a year. I'm talking about multiple years, if not decades. So now, this is something that you believe in, that you want to hold on to for the long term. And in the stock market, if you don't want to get into the business of finding, researching, and investing in individual companies, well, then you can also invest in ETFs. An ETF is an exchange-traded fund that gives you exposure to a lot of different stocks. So now you can invest in ETFs that give you exposure to the 500 biggest companies on the stock market, the S&P 500. You can invest in ETFs that give you exposure to tech stocks. You can invest in ETFs that give you exposure to energy stocks. You can invest in ETFs that give you exposure to healthcare stocks. So if you know what it is that you want to invest in, but you don't know the best company to invest in, then you can just invest in an ETF. And now, if you're still like, I don't know how to go about doing that, well, then what you can do is just set up a passive and automated system where now every week you have some money that's automatically leaving your bank account and automatically being invested into the ETFs that you want to invest in. I have one of these set up where every single week, for me it's on a Wednesday, it doesn't matter what day you pick, but every Wednesday money gets pulled out of my bank account and it gets automatically invested into my portfolio of ETFs. So that is my passive strategy, but then I also have an active strategy where now I'm looking for good investments, whether it's in the stock market or the real estate market or the crypto market or with startups. I'm looking for these good investments, and then when I see a good buying opportunity because prices go down, well, that's when I come in and buy. Typically, now it's becoming a little bit more awareness of this on YouTube thanks to education on these platforms, but typically what happens is when these asset prices go down, people get scared, they run away, and then they sell. But for me, that's a great opportunity to buy. Like I was buying when the 2020 crash happened. I was buying pretty aggressively. I was buying real estate after the 2008 crash happened. I was buying cryptocurrencies when we saw the last cryptocurrency crashes. So for me, crashes and down markets are opportunities for me to buy instead of opportunities for me to panic and sell, and that's where you want to find the right opportunities there. Now you can also generate cash flow from the stock market. Like if you invest in a dividend paying company, some companies have a big profit at the end of the year and they'll just give it away or most of it away or some of it away in the form of dividends, which is literally just like a cash payment to you and it gets automatically deposited in your account. Many companies pay a dividend every quarter, meaning every 3 months. And so if you invest in these dividend-paying companies, your goal is, again, seeing this appreciation, meaning seeing the long-term value of your stock investment go up. But in the meantime, you're getting paid while you wait because you're getting this sort of cash flow. So if your goal is just to build another stream of income, you want to have another stream of income coming in that's passive, well, then what you can do is you take that passive investment strategy that I was telling you about and now look for either dividend-paying stocks or dividend ETFs. That way now you're just working over the years to build up another stream of income, because if you do that and you stay consistent with it and you do it for years, you do it for a decade, what you're going to see is now all of a sudden you have just built a brand new stream of income, and the goal is for your stream of income to replace your job income. That way now you're working for your job income, but then you also have your passive income from your dividends or your real estate that's paying for your lifestyle. So now you just doubled your income without doubling your work, because now your dividend income is paying you without you working, and then your job income is paying you with your working. And then whenever you're ready, you can either cut down hours from your job or you can keep working the job. That way you can keep building up your investment assets. But the key here is you need to know what your goal is. Do you want this? Do you want this? And know where it is that you want to invest. The fourth habit that you have to understand is now how do you save money and where do you save money? So the basic end of this is you got to know how to live below your means. By the time you're 40, you have to know how to spend less money than you make. But you got to understand then when and how do you save money, and when is it right for you to spend money? Because when you save your money, well, there should be a reason. And what I like to say is that you should be saving money for one of three reasons. You should be saving your money for an emergency, you should be saving your money for an investment, and you should be saving your money for big purchases, and that's it. If you're not saving your money for one of these three reasons, then you are not saving your money smartly. So every saving dollar that you put aside needs to have a strategy and a reason to be saved. Now when it comes to your emergency savings, you want to have somewhere between 3 months and a year's worth of expenses saved, depending on what your risk tolerance is. If you hate the idea of taking risk, if you don't like the idea of investing, then put aside a year's worth of expenses in your savings, because that will even cover you through the worst case scenario, and then invest everything after that. But if you have a higher risk tolerance, then maybe you only need 3 months worth of savings put aside. But then this also goes to now, how do you now save strategically when it comes to your spending? Because in the beginning, we talked about spending your money when it comes to most of your expenses. But now as you start to become a little bit more financially savvy, as you start to build wealth, you want to be spending your money the smart way and not just saving every penny because, well, you can. Because the ultimate goal of having money is to be able to use the money, because if you don't use your money, it doesn't give you any value. So now the question is, how can you put your money to work and use this in a way that's going to give you the most benefit? Like one thing that you can do, which is what wealthy people do, is they use their money to buy back their time. So if there are things that you hate doing, maybe you don't like going to get groceries. I hate going to the store. If you don't like going to groceries or getting groceries, you don't like cooking your own food, well then now you can use your money to pay somebody to do that. Now there's an added cost there. You got to pay somebody to get your groceries. You're going to pay a premium for that. If you're going to hire someone to cook for you, there's a cost to that. But you're buying your time back. And now as you're on that journey to build wealth, you have to start valuing your time. If you can pay somebody $25 an hour to cook for you and your time is worth $50 an hour, well, you just bought your time back and made a profit. This also means you got to understand what's important to you. For me, name brand stuff and a nice car aren't on the top of my list. However, I do like comfort and I do like certain luxuries. Like if I fly international, if I'm going to India to visit family, that is a 20-hour journey on a plane. Well, on that plane ride, for the most bulk of my life, I was flying economy in the back seat, sitting like a sardine. I don't like doing that anymore. So now I'm willing to pay for that added comfort of sitting in business class or first class, which costs significantly more. I mean, it costs like 5 times more to sit in a business class or first class seat when you're going international, but it's worth it to me. So I will pay a lot more money for that because that value gives me value, something that I want. And when I travel, I like to be able to travel. So I spend money on traveling. I want to have a nice hotel room. I used to be the one that would fit 10 people into a $24 or $44 a night hotel or motel room. Now I'm getting nicer rooms. I want that nicer comfort there because that provides more value for me. And you got to understand now, how do you save strategically? So we talked about the 3 places, right? The reasons why you save your money, but now don't just save all of your money to save it as you start to get deeper into your wealth journey. Figure out what's important to you. Spend money on the things that provide value to you, and the things that don't provide value, well, yeah, you can make those sacrifices because it's not that important to you. If you keep living that life where all you're worried about is what other people will think, well, you're going to be spending your money to make other people who don't really care about you and people you don't really care about, you're doing it just to impress them, but no one really cares. You're blowing your money on the things that don't matter, but this is where you got to know how to do it the right way. And this brings me to number 5, which is you need to know how to protect your wealth, because now as you start to build more wealth, what you're going to realize is when people realize that you have money, they're going to try to take their hand, put it in your pocket, and take some of your money for them. And you will see this in a number of different ways. Maybe people will try to sue you. Maybe it'll be in the form of taxes. Maybe it'll be something else. But this is where you have to know how to protect yourself legally and financially by building shields around yourself. And I'm telling you this from personal experience. Like, my first real estate deal ever was the most difficult and probably one of the biggest headaches. Now, it was a profitable deal. I still own that property today, but I learned a lot from it. And my first tenant also sued my real estate company because the claim was that my bathtub in that property was too slippery when the water was on. So the claim was that because they would turn the water on, the bathtub would get so slippery that it caused this person, one of the tenants there, to slip and fall. And because of that, they were suing my real estate company. Now, the interesting thing was, then the reason why I have a property management company is because they document everything. They refused to let my contractors in after that happened because they said that there was a chip in the paint on the bathtub, which was about the size of a quarter. So that chip of paint, they said, contributed to the bathtub being slippery. However, they did not let us make that repair. And second, they'd also admitted that the reason why they don't want anyone to make a repair there is because the person who slipped fell at a barbecue playing some games, and that's where he got hurt. And so because he fell at the barbecue, that we can't come in there. So we had all this documented, so it was a frivolous lawsuit. The judge threw it out. However, it was something that I had to go through and learn, because in America, you can sue anyone for anything. It's just the way the system works. So how do you protect yourself? Well, for one, if you're investing in real estate or if you have a business, you want to have a legal shield. Maybe you create an LLC or an S Corp or maybe a C Corp, depending on what your company is. You got to talk to a tax professional or an attorney in your area. Most of the time, probably an LLC or a S Corp is going to do the job for you. And then once you have your business entity set up, you also want to make sure you have insurance. You got to have insurance for your property, your properties. You got to have insurance for your business. If you own a business and you have employees, you got to have separate insurance for that. So you want to make sure you have your different insurances set up. Have health insurance for yourself. Have health insurance for your family. Have your insurances for your property, your personal property, your car, your home. You know, all these things are not fun to have. Maybe you have life insurance as you're working to build your wealth. Life insurance is something that can provide you the sort of bridge insurance as you're building your wealth and owning assets, because your goal should not be to rely on your life insurance to take care of you or your family. Your goal should be for your assets to take care of you and your family. So that's one of the things that you can have set up. And then you want to make sure that you talk to an attorney, an estate planning attorney. An estate planning attorney is going to help you now understand how do you put all of your assets together. That way, whenever your time comes, because all of us have a limited time on this earth, how will your assets get passed on? Maybe you have a will, maybe you create a trust, maybe you do some other sort of fancy estate planning, depending on how much wealth you have, on how you can start planning to pass your assets down to somebody else. So these are things you need to plan for, because if you don't, then you're going to run into a situation where you can create a lot more risk, a lot more fights within the family, a lot of other issues, but you can avoid all of that by just planning for it. Now, I know no one likes to plan for worst case scenarios. Like, insurance is not something fun you want to pay for. No one likes to plan for what happens after you die. But the reality is, if you don't, and something bad happens, well, you're taking on all the risk, and it can cause a lot of issues when you can prevent all of it by just protecting your wealth and taking these precautions when times are okay. I mean, it's just like investing your money. How do you take advantage of a market crash? Well, you learn and you put money aside when times are good. So it's preparing when times are good for a bad time. And it's the same thing here, where you want to prepare for when things go wrong during a good time. If you enjoyed this video, you're going to love the video that I made where I went over the 2 things that you need to buy that will make you richer. And you can watch that video by clicking this button right over there. Thank you for watching, and as always, keep hustling. So you have to believe in yourself first. And once you do that, you're going to continue to learn. You'll find ways to increase your income. You'll find ways